Hey everyone, James here, back from my amazing adventures in Canberra, and well done to everyone who did everything amazingly well. Having a little scotch, because it's a Tuesday, it's been a great day. That one's for everyone out there that's competing hard and doing quite well. I've got some chicken here, and I've also got the gravy on the way. I've got some veggies coming as well. Now, it's been I'd say it's a fascinating week, because that's a throwaway comment that you can just always say it's a fascinating week, but it's not really been that fascinating a week. I think that you can see that there are certain things that are happening that seem fairly self-explanatory. Now, I was just on BizTech Asia, brought to you by the Australian Mutual Funds Exchange today, as I was, talking about a few of the bits and pieces that are going on in the markets and a few of the things that are sort of moving things around. They asked for my best trading advice, which for myself is going to be, my main philosophy of life, which is that once something has been talked about enough, it stops being an impact factor. It stops being a thing. That's my theory of thing. So if if something becomes discounted with enough people talking about it, by the time you hear about it on Bloomberg or CNBC, it's done. People already know about it. The market, trust me, the market already knows about it. It is no longer a shock factor. If you call me and say, hey, the debt ceiling is something we really need to worry about, I'm probably going to tell you why it's not, because it has already been factored in. Things not happening with the debt ceiling is a risk, but it's a risk that needs to be valued in that sort of statistical, what chance is there of this thing happening versus what's the downside of it, and then you sort of price and accommodate your allocation effectively and appropriately. That's what I do. That's why you need me to do these sorts of things. Oh, I'm also in our place that we're renting here at in a different part of Sydney, which is good. Not my usual Northbridge haunt. I'm looking forward to getting back to my Northbridge place when my new office is built. I'm really looking forward to that. But look, on the note that we're doing here, so they asked me for that, and I talked about the things that have already been factored into the market, what has and what has not been factored into the market, and I think that the Fed pausing, that's now been factored into the market. The recession has been factored into the market. It's a soft recession has been factored in, has been baked. I don't want to say baked in, it sounds stupid. Factored in. What hasn't been factored in is if it's a huge recession, yet to be baked in, which then means that earnings for companies in the US go down substantially more than they should. That's something that has not been factored in, or it has been priced, a small amount of it has been priced in, but not a huge amount of it has been priced in. And they asked me about my best trading ideas that I've got coming into this one. So I think that, and if you just want to know, I'm just going to go for it and just tell you, and just based on whatever hits my mind from what I've read over the last few days, this is where it's going to go. The Morgan Stanley Consumer, they have a consumer survey that goes out talking about consumer expectations. Basically, spending on services will capitulate fairly soon. That's something that you need to factor in. I would not be in anything in services at the moment. Also, something that is on my horizon is the fact that big tech, and this is good, big quality tech, trading at 30 times, I think, versus the rest of the S&P 500 trading at 16 times, has been carrying the entire market on its shoulders. That's something that probably just want to be a little bit hesitant about. I think that oil is also a great buy. So fuel, energy companies at this particular point is where you want to be having a look at too. But first and foremost for me is that because we've got this next stage of earnings downgrades that I don't think has been factored in exactly how bad that's actually going to be. I don't think it's going to be calamitous. I just think it's probably going to come off. I think that we're also going into a season where markets tend to sort of dither around a little bit. Also, this is one of those rare opportunities where the yield curve is inverted, the most inverted that it's been since the 80s. And the Fed is pausing, and usually it's not this bad, signaling that it's going to be a pretty ordinary recession. I don't want to say exactly how bad, but people get a bit freaked out about that. But the idea with this is that the yield curve is obviously inverted, so recession is coming. The Fed is pausing. Usually the Fed pausing is a great time to buy markets. However, again, Morgan Stanley, this is sort of their comments and a few comments around the traps as well, saying that now is sort of different from the times past when the Fed has paused, because this yield curve is so heavily inverted. That I agree with, also because the idea of being, and this is such an amazing innovation, is that when you've got the alternative in the bond market where it is, that the valuation, that easy money, risk-free return can actually be accumulated just right there in the same market that you're already investing in, or effectively the same market you don't have to go anywhere complex or crazy or severe. You go to the US 10-year Treasury market to receive a return, and a return, not only a return on the just getting income at 4 to 5% per annum, depending on what you're looking at, but also the fact that you think that is actually going to probably rally in capital appreciation as well, because yields are going to come off. Yields come down, bonds go up. Thank you, everyone, for filling us in on this one. So that's sort of where I see these things going. Bonds, yes. Credit usually goes up at this particular time. 9 out of 10 times, I think it was, that credit, investment grade credit usually goes up. Happy to own that as well. Got some great managed funds, mutual funds, that invest in credit too. Got some great mutual funds that invest in bonds as well. Look at amfix.com to find out more about mutual funds in the bond market, in mutual funds in the credit market. There are some amazing funds that are in this sort of space. They will go. And also, these aren't necessarily long-term holds, although they could be. You can buy these things and invest and just have them for a couple of months and just ride that up and then just cash it out and then just go to the next thing. It's very, very easy to do. Again, amfix.com. That's sort of how that goes. The other interesting one is gold. Everyone's gold, yes, gold usually goes up. Gold usually goes up at this particular time. It has gone up, it has run, it has gone quite well. What is interesting to me is the fact that gold, and I'm just trying to think, 5 out of the last 5 times, 50% of the time, gold comes off in the 3 months following the last Fed hike. And usually it comes off on average 13%. Gold has had its run. I think that there is a chance to buy gold. I don't think that is right now. That's all that I'll say about that. Look, those are the ideas that I've got going on in the market at the moment. I'm happy to continue to switch out of equities into the bond market. I will continue to do that this week. I'm happy to do so. But look at some of those bond mutual funds. Go to amfix.com and look at some of those bond funds and look at some of those credit funds, because there's some really good ones out there. I'm going to get back to my chicken. And thank you very much for joining me. I've got my scotch as well. Thank you, everyone. God save the king, depending on whatever it is you're doing, and that's that. But have yourself a good afternoon and a good evening and a good morning for tomorrow, and just pay attention to what's ahead. Oh, also, the other one, G7. G7 is next week in Hiroshima. G7. That's a big deal. It will continue. G7. G20. Anyway. It will continue the decoupling moves between the US and China. Pay attention to that. That's a big deal. And we just have to be aware of that. That will continue more of the flow into India. Do not ever discount India at all. Some amazing Indian funds also on amfix.com. However, that's going to be the next catalyst for the next big move into India, as we're seeing that China will just not be able to deal with. But I think that the catalyst for that is going to be the G7 coming up in Japan in about a week and a half's time. So pay attention to that. Anyway, any questions, just let me know. But check out amfix.com for any more information and for information on those funds which I've mentioned today, or those ideas that I've mentioned today. Have a good one. See ya. Mark well.